Invest in real estate without owning property. In 2025, you can own real estate shares without ever signing a mortgage. That's right. But before we go further, please make sure to like this video and subscribe to our channel for more great real estate investing tips and tricks. Thank you. So whether you're aiming to build wealth or diversify your portfolio, today I will share 3 exciting ways to invest in real estate without even stepping foot inside a property. And with each method, I'll reveal its pros and cons so you can decide what works best for you. Let's dive right in. Why own real estate? In 2025, owning physical property can be out of reach for many people. High purchase prices, mountains of paperwork, tenants to manage, and repairs to tackle. Not to mention rising interest rates, making financing a distant dream. But if you're not ready to buy, don't sweat. You can still invest in real estate without being a homeowner. So what are some alternatives? First up, we have REITs. What the heck is that? REIT stands for Real Estate Investment Trust. They're like regular companies, but instead of selling tech gadgets or coffee, they own and manage properties. Think shopping malls, office buildings, even apartment complexes. These properties generate rental income, which REITs use to pay investors just like you. As a shareholder, you'll receive a portion of the rental income based on the number of shares you own. It's like collecting rent, but without having to find tenants or deal with leaky faucets. And the best part? REITs trade on major stock markets, meaning you can buy and sell your shares as easily as buying a cup of coffee. No need to wait for months while someone moves out. If you've invested in stocks before, REITs are a piece of cake. All you need is an online brokerage account. It's simple. Buy low, hold steady, and watch those dividends roll in. But wait, before you dive headfirst into REITs, let me spill the tea on the downsides. First off, REITs are subject to market volatility. When the economy takes a nosedive, so do REIT prices. Plus, you won't have as much control over properties as direct ownership. Say goodbye to picking paint colors and say hello to shareholder meetings. The other con is the paperwork. With REITs, there's not much paperwork involved in investing. But when it comes to taxes, you'll need to keep track of your dividend income. Set aside time to organize those 1099 forms come tax season. Otherwise, Uncle Sam might not be too happy when he's expecting his cut. Okay, next up on the list is crowdfunding. And I know you might be thinking, wait, hold up. Isn't crowdfunding like asking your friends for money? Not quite. Crowdfunding platforms bring together investors like you and me to fund real estate projects. Think of it as a way to pool your resources and buy properties you couldn't afford alone. It's like having your own little investment club without the awkward family gatherings. Instead of donating to a friend's wacky idea, you're investing in vetted real estate projects with the potential for solid returns. You'll need to create an account on a crowdfunding platform and choose a project you want to support. Each project will have details like the property type, estimated returns, and the developer's experience. But wait, before you start scrolling through projects, let me fill you in on the cons. First off, investing in real estate through crowdfunding can be riskier than traditional investments like stocks. After all, you're putting your money into specific projects rather than established companies. And if the project faces delays or doesn't perform as expected, you could lose some or all of your investment. Secondly, it's not as liquid as stocks. So once you put your money into a project, you're typically locked in until it's completed. This means you won't be able to sell your investment quickly if you need the money. But there are some platforms where you can sell your shares before the project is finished, but you may have to accept a discount. Next on the list is fractional ownership. If you've been eyeing rental properties but think they're out of your budget, fractional ownership might be your saving grace. This newer option allows you to buy a slice of a rental property and reap the rewards of being a landlord without taking on all the responsibilities. With fractional ownership, you can diversify your real estate holdings without committing to a single property. It's like owning a piece of the American dream. So how does it work? Well, imagine a delicious pizza. Now picture yourself owning not the whole pizza, but just a few slices. That's kind of like fractional ownership. A platform breaks down properties into smaller fractions, allowing you to invest as much or as little as you like. You'll still receive rental income and share in any appreciation when the property value increases. However, you'll also need to chip in for maintenance and property taxes. It's like sharing expenses with roommates, but without having to deal with the drama. So if you're considering giving fractional ownership a try, it's important to be aware of a few potential downsides. Firstly, these platforms typically charge various fees. There are usually upfront fees when you buy a slice of the property and ongoing fees for managing the investment. These fees can eat into your profits, so it's essential to factor them in when evaluating the potential returns. Also, not all properties are available for fractional ownership, so you might not find the exact investment you're looking for. For example, if you dream of owning a beach condo, it might not be an option on these platforms. So which one should you choose? Well, it depends on your financial situation, risk tolerance, and long-term goals. Here's a quick breakdown to help you decide. REITs are a great option if you're new to investing or prefer a hands-off approach. They offer liquidity and diversification, making them perfect for beginners. Plus, REITs provide passive income through dividends, allowing you to earn money without actively managing properties. Just remember to consider the market volatility and potential tax implications before diving in. Crowdfunding might appeal to you if you want more control and higher potential returns. By investing in specific projects, you can choose properties that align with your investment strategy. However, it's essential to research projects thoroughly and be prepared for the risk of delays or underperformance. The limited liquidity might also be a downside if you need access to your funds quickly. Finally, fractional ownership is an excellent choice for those seeking rental income and long-term equity. Building ownership can provide a steady cash flow and potential appreciation, allowing you to benefit from the growth of the property market. However, keep in mind the additional fees associated with this option and the limited availability of properties. So which one would you try first? REITs, crowdfunding, or fractional? Comment below. And if you want to learn about other passive income ideas for 2025, check out my video. It's filled with unique and exciting ways to earn money without a traditional job. Who knows, you might discover a hidden gem that you didn't know existed. Click here to watch now. And don't forget to like and subscribe. Thank you for watching, and I'll see you in the next video.